right, the last panel of the show, but it'll be a good one, so don't leave quite yet. So look, we've seen the news this week. We've heard about the CFTC suit against Binance, the SEC suit against Coinbase, and you might think to yourself, like, is there a future in the US market for crypto? And these guys, these big brains, investor brains, think there might be. So that's our topic. All right, guys, from the top, Dani, is the US done, yes or no?
Whoa, hard question. I think innovation will still predominantly come from the US, but it's possible that a lot of the token-based projects might shift abroad.
Steve?
I think regulation is always up and down. So now US being hard on it. But if you think about a year ago, South Korea is very hard on it. And then a year ago, China was hard on it. So I think it's just throughout the innovation cycle, it's just a matter of what it should be happen. So I don't consider this means the US end, but it's just we are moving forward.
Short answer, no. Don't think it's dead. I remember back in 2017, 2018 time, all of the good infrastructures are US-based teams. So having the Bay Area leading the way for tech development, it's always the place we find some of the best founders. So in that sense, I think US is still one of the area that we're going to be focusing on for investment. And also talking about China, back to Steve's point, I used to run listing and investment at Huobi, and we were pretty much shut down by the Chinese government twice. The first time in 2017, we were forced to exit completely 100%, and then like 2021 September, when the new document about you cannot really operate exchanges if you're based out of China or even helping doing consulting work for Chinese exchanges, you need to be moved out. So we'll be exit from the Chinese market completely again in 2021 and then sold to a third party. So after all that's done, Chinese market is still one of the most active market in the space. It still accounts for 84% of the whole trading volume, if I remember correctly. I just did a show with Run from CNBC, and it's a quite fascinating number, right? Asia as a whole still counts for a lot of the trading volume there. So regulations of when we see documents like that coming out, at first it can be harsh. It can, short term, maybe impact the price, and long term, I think is always good because fundamentally it opens up doors for more retail users and legitimate institutions. So I look forward to what it will look like for our industry long term, and I think US is still a very innovative place for tech developments for crypto.
Yeah, no, not much to add from my side. I think I agree. I don't think it's the end. We will maybe see some talent flows from the US to other markets. We're already starting to engage with our portfolio selectively, like having these conversations. Does it make sense to be based elsewhere in the short run? But I'm still very optimistic about the market. And I think to Ciara's point, like when I look at, I mostly focus on Asia. And while I wouldn't necessarily say that a lot of these jurisdictions are friendly to crypto, at the very least there is clarity in certain markets like Singapore, Dubai, etc. And so that clarity, I think, is the bare minimum that a builder might require to feel comfortable. And so I think that's one of the things among many that Asia has going for it.
Right, there are rule books around Asia, not perfect rule books, but they do exist. So I guess the next question would be, like, what's changed in the last year? Like, as the US has had its war on crypto, right? How has your deal flow changed? Have you seen more deals pop up from Singapore or Hong Kong or Europe? Or do you still see that balance of deals globally?
Okay.
Yeah.
I think two ways. So price-wise, the valuation came down a lot. I think it depends on stage you're looking at, but back in November, it's peak of right before the bear market starts. Valuation I used to see is early stage, it means pre-seed Series A. I used to see 80 million to over 100. But now most of the deals I'm looking at for last 2 months is sub 30 valuation. So price down a lot. The second point is the quality of projects, the founders are still improving, steadily increasing. So I was in ETSO 2 days ago. I was a judge, but the quality of the developers and founders are amazing. And also deal-wise, I see they're much more the strong, the consumer, more application focus. I mean, there are good infra, but I see the more application deal flow that I'm looking at. So that's two angles I can share.
Well, yeah, I mean, I think for us, we have historically seen most projects coming from US or Asia, and the flow of quality projects seems to be stronger in the US, and actually Canada has had a really strong flow of founders as well. I think because they're a little more focused on the company building entrepreneurial side of the ecosystem. And I think a lot of the projects, at least that have come through my desk that are Asia based, focus more on maybe the tokenomics aspect of, or like the DeFi games aspect of something. And I think that's probably a reflection also on the regulation that it represents each country.
Well, great to Steve's point. Valuation definitely came down to a more reasonable range the past year. And then as for deal flow by region, we do see lots of deals now pop up in Hong Kong, and just because Hong Kong from the end of last year until now, this half-year period has been moving really, really fast on Web3 regulations. And basically three things to sum it up. First, ETP and ETF products. And second is the retail exchange license, where you don't have to just serve qualified investors. It's open up to just all the retails, and it's is one of the biggest move ever happened in Hong Kong and China-related regions. And third is NFT. NFT is classified as a commodity, so it's gonna be for sure 100% not a security, not like states it's trying to classify Ethereum and all the other coins as the security. So NFT trades and primary market launch is gonna be very, very easy in Hong Kong, so access to the greater China area as well. So given that, and now Hong Kong's travel rules between mainland China is so much better, so that it's like 10 minutes by train to Shenzhen. It's connected, and Shenzhen is where the tech talent hub are for all of the Web2 big companies like Huawei, Tencent, some of the Alibaba sub business centers headquarters are all there, so it has access to great tech talents there. So we see a lot of good projects now based out of Hong Kong instead of Singapore. It's just because Singapore is so hard for actually getting a qualified work visa. As for Hong Kong is now giving out 500,000 visas to Web3 and tech talents. Yeah.
I guess one question could be from that actually is, in Asia, do you decentralize your talent pool, right? So if Singapore says no to work visa sponsorship, but you still want to incorporate there, do you look abroad? And do you have any like emerging markets where you see lots of good talent coming from here in Asia?
Speaking of talents, I think we still see majority of the talents are still, kind of China-based, and then also very good developers in India as well. And we see more in Southeast Asia, and Korea is actually a very, very good market. That's why we travel here so much. Good teams. It's just a more closed-up ecosystem. I feel like building a trust here in Korea, you have to work with local companies. It's kind of like Japanese culture, right? So it's harder to break in, but once you're an insider, the customers here and partners here are very, very loyal. That's one of the things we notice.
Maybe, yeah, just to echo those thoughts. I think India in particular, I view as being very high potential when it comes to this particular topic. Supplementing your team with usually engineering talent, but I think India strikes me as sort of the perfect confluence of very strong technical talent, but also like, English fluency and just success stories in the Web2 world of a global go-to-market, right, on the SaaS side, for example. And so you pair that with, frankly, the headwinds that you're seeing in South and Southeast Asia in tech more broadly, right, like lots of layoffs. Like I think as challenged as Web3 is today, I think Web2 is also going through its own existential crisis in terms of what works, what are people willing to pay for. Like VCs and builders now are asking themselves these questions. And so that just suggests that there will be even more talent that is open to opportunities, potentially starting up or potentially joining a Web3 business from these geographies.
No, I just wanted to add the Japan market because we cover most of them. So Japan-wise, for last 6 months, a lot of talents moved to Singapore as a normal trend. But for last 2 months, government noticed that, oh shit, all the excellent founders are moving out of the country. So they put actually very solid, clear regulation, Web3 white papers and such for last few weeks. So now I heard that a lot of Japanese founders moving back to the Japan and then to join the mega support from government.
Also, back to Japan, one of the reasons it's kind of slow for Web3 is because the tax is so high. For retail to trade on Bitflyer and CoinCheck, to pay 55% of tax, and that's crazy. And now they're working on bringing it down. So it's definitely more welcoming and open.
It's actually a good point you make because tax in Asia can be quite high, right? Here in South Korea, it's not a low tax jurisdiction, right? And yet you also have excellent talent here. So how do you balance that when you're doing a deal, right? Do you look for the advantageous tax regimes, or you prefer it to be like full of talent as well? Or is there like a medium there to look at?
I don't think we care.
You don't care?
We don't care. Yeah, we basically were like, what's your runway? What's your burn? Like you figure out however you're doing this, you figure out where your talent comes from, you figure out whether you have an office or not. Like, what's your burn rate? What's your run rate? And then you figure out if that deal makes sense or not. Like, I think like with VCs, it's actually pretty good to like be hands off on a lot of the things. You don't want to end up babysitting all your founders. You want to give them autonomy and empower them to be the great entrepreneurs that they're going to be.
So
it's always a global team, anyways, for projects. Once they made it, like Near have a very big team here too, right? So like they have to figure out their global burn rates for hiring local talents and the tax issues.
okay, so moving on to like the bear market part of this, right? Like Bitcoin isn't at 10K like some thought it would be last year. It's at 26 odd K, which is not bad, but we're still in a bear market. So as VCs, how has your like processes changed in the bear market? Do you take longer to do deals? Is it not changed like that? Valuations, of course, have changed. What about like analysis of burn rates and runways? How's that changed?
I mean, I think that, we're calling it a bear market, but like that's really relative. Like, I started back in 2017 working for like Joe Lubin, early days of Consensus. Like we saw a lot of ETH, like, 80, like 200 was like, okay, it's not terrible, If it once it like crossed 1,000, people were like, yes, we're going to the moon, right? That sort of vibe. So even though it's like lower than the latest high, it's actually still quite strong. And there's a lot more institutional capital that's interested in deploying in the space. So I kind of agree with what Ciara said earlier, that like valuations are in a more reasonable place, but only because they got to an outrageous place before. Like you were just looking at this thing going like, I think I'm exit liquidity, right? Instead of like, being an early investor, you're like, I think it's like the opposite cycle that's happening. We're calling it a bear market. Maybe that becomes more true when other economic macros or indicators sort of corroborate a global recession, like then sure. But ultimately for us, it's really about like supporting builders who are building valuable technology, infrastructure, DeFi, consumer applications, whatever that may be, and that the fluctuations of the market really shouldn't impact. Like a good project is a good project, in any market, and then you figure out the details of how that comes together.
I think a bear market is not associated with the absolute price. So if you think about Bitcoin up 70% this year, why is it? If you look at this as price, I don't think it's the right way to say the bear market. But I think bear market definition comes from liquidity. I think the market is basically low liquidity from traditional market that spoil into crypto. So because it's such a low market, low liquidity, I think we can call it a bear market. So in terms of investment wise, I think, let's say, bull market, I saw the 100 deals, 90 of them are scam, and 10 of them are due diligenceable. But now I would say I see the 50 deals, but maybe I see the 10 of them are due diligenceable. That means the concentration of deals that I want to do diligence is higher. So for me, price is lower, quality is higher. So if you have money, I think this is a golden period for VC investment.
So as a builder then, right, you have a better chance of going before your desk and getting your eyes on the project in this market. Is that what you're saying? since there are less obvious, BS deals, and there's higher quality, and you're still looking at deals?
So yeah, so I think it's more higher quality deals. So as Augie mentioned in the room, I think we can spend more time on due diligence, and then on the deals that is due diligenceable. So I think for VC, I think this is a sort of a normal. We want to back the founders when they have a hard time, rather than we don't want to be just one of them to just put the money in 48 hours, and we want to spend some good time to understand the founders better. We want to support them when they need the really support. So for me, I think this is when VC can be VC.
Yeah, to your question, I think the net effect is a bit difficult to understand, just because while there's less noise on the builder side, there's also frankly less noise on the investor side, and some crypto funds have sort of moved on to quote unquote greener pastures. So is it easier? Is it less easy? That I think is harder to deduce, but it is certainly true that I think we now have the luxury to do real diligence. Which is something that sounds obvious, but maybe wasn't so obvious in the last bull cycle. And to Steve's point, I think we also have, at least for me, I've had an easier time assessing what I consider to be one of the most important founder attributes, which is what are their motivations for building what they're building. They're almost self-selecting into what is today a very crappy market. And so, perhaps they're not in it for solely monetary gain, but for other reasons, which are more enduring, if that makes sense.
So less mercenaries, more actual change agents, I guess.
Something like that.
Okay.
We are very happy of this current investment period, actually. So okay, back to our season. We are a 100 million early stage fund, so we have to try to get in and lead the deals. So back in bull market, we're trying to compete for other VCs, trying to give out a term sheet that they can just give out a term sheet in a day or two. We can't do it. We have to take the time to do cold due diligence, where we found in bull market, a lot of the other, I don't even call them VC, like money, they don't really do it. And also, they don't even take time to understand the token warrant ratio and whether they're reflecting to a certain portion of the token, founder's token, investment token, or just the whole pool of the token. So it's unbelievable how much due diligence they do. It's very minimum. So we can't compete with that. Now, we can actually take the time, and the deals can wait as well. Other than that, I think it's a great time that we focus on post-investment. We can now do weekly and bi-weekly call with the deals that we invested in the last year, and really help them to focus on, shifting their product or figuring out their go-to-market strategy. I think it's a really good time for builders to actually sit down and spend more time to figure out their overall strategy and also manage their treasury.
Good. So things are good for you guys then, right? So,
To Steve's point, it's the best time to invest.
so for the builders here at the conference, what does a DD process look like these days for you guys, right? So if they pitch you tomorrow on the project, what can they expect in this market for DD, for check size, for that whole process?
For us, the check size didn't really change. It's still the same check size. And for the due diligence part, it's rounds of calls with our team, and then access to the data room, and we do cold due diligence to see whether the codes they built are the same as they talk about for the product site. And then we even do background check for teams as well. And team is always the most important part. And in the end, we give out, term sheet based on our negotiation. We recently passed the deal just because the team is actually really good, and they want to do it like kind of a new type of exchange. Decentralized exchange was centralized exchange experience, which we think it's going to be the future, as centralized exchanges now tons of problems happening. But we had to pass on the deal just because during the due diligence process, we found the founder had exchange before. It's not in crypto, but then got sued by some retail. So it was, during bull market, you probably don't have the time to do this in-depth of due diligence.
So as a quick follow-up question, these days, lots of DeFi projects, people are under pseudonyms, right? Like they're not Sam Reynolds, they're some Discord name. would that be a blocker for you? Would you want to make sure you know their real name, their docs, or are you comfortable investing in a pseudonym?
Actually, it depends on what they're building. So, like one of the teams we are investing in ZKX is a ZK-backed DEX where they just did a Dunkirk event where the website is shut down, then the team all disappear for a week, and then users can still get access to their funds and get their funds all retrieved back to their accounts. So in that sense, the team doesn't matter. So it's like truly decentralized in some sense of the things. You can just track the technology itself, then it doesn't matter.
And I guess there's also the degree of doxing, right? Like we've invested in projects where like to the world, they may be anon, but like to investors or to certain parties, they are not. And so, I mean, that is my personal preference, at least currently held, which is—
Me too, definitely.
Yeah, I'd want to know who it is that I'm, working with. But, I understand obviously, especially in these times, why you may not want to, in certain geographies, reveal that you are a crypto builder. Sure.
I mean, Sam, you told us the story about those two brothers.
Yeah, I mean, with Solana, for instance, right? There was these two brothers who had built up this Russian nesting doll of projects because no one did DD on them to realize that they were all the same person. So that's a risk, but at the same time, as you said, right? Like you might not want to dox yourself to the world because in the US that might mean crazy stuff or elsewhere in the world as well. Steve, what do you think about this?
No, I great point, Augie and Ciara. So I'm more about, on due diligence for me, 4 important thing out of 9 is founders, product, market, and community, and the founder part is most important. So I prefer to talk with the founders a lot because that's who I'm going to support for the next few years. And if I don't know a person as a human being, it's very inefficient for me to do a VC. But after I heard the Ciara's example, I think I can be more flexible. I can completely agree that it's basically one beauty of the Web3 and anonymous part. And then if application in appropriate way, maybe I can be a little open-minded on that part.
I guess it's just you don't know their true identity, but I still get to see them, It just, at least it's not an AI. It's a real team.
Problem.
Yeah, real problem.
So in this bear market, we'll call it that, like, has your thesis changed for investments? Like you mentioned earlier, Dani, that one of your things that you like to look at is, can this project be ported to another chain, right? Is it chain agnostic? Is that more important now in the bear market, or is that always important, bear versus bull?
No, I think it's always important that a founder has like a long-term mentality to like how an ecosystem is going to develop. So like, what I mentioned earlier is like the internet as it exists today is not one protocol. It's like a series of technologies and protocols that talk to each other. So we expect that the internet of the future will also be connecting all these different technologies together. So for example, like I'm a fan of what like Near Protocol is doing with Boss and like having decentralized front ends that essentially work anywhere. Because like when I go to the internet, I check my email, like no one asks me like, do you have an account with AWS? Like, please log in to read the New York Times. I just like, I bought the New York Times and like they serve it to me and I don't care like where they're storing their data or like where their security is coming from. I just trust that particular application or publication to give me, what I'm looking for. And so I think that like ultimately when you think about blockchains, layer ones, their infrastructure and infrastructure is invisible to consumers. So, I want to talk to founders that have something more to propose than like, I'm going to copy this product. Like it's basically like, you remember like back in the mid 2000s, there were people who were doing like Uber, but for China, Uber, but for Vietnam, Uber, but for Brazil, right? It's like there's something similar happens in a lot of blockchain projects, and you want to make sure that they're thinking about it from like an innovative perspective, that they're thinking about like how they're going to like transform or improve some piece of the ecosystem, and that it's an idea that supersedes the underlying technology.
Right. Less of the copycat nature to make a quick buck versus actually trying to change the market. Steve, what do you think?
Sorry, what was your question?
The question is about like, do you have like an underlying thesis?
Yeah.
Bull
So,
versus bear.
So I don't think this is changed because in bear market. I think it's more about degree of each due diligence category, that whether I should focus a little more on this category or not. So let's say in bear market, I think from founder's perspective, the one that I try to read the most important is whether this founder is resilient. Because resilience is goddamn important based upon my the past investment. So, or if the community-wise, in bear market, if someone can build 100 people, that means that 1,000 people in bull market. So it's more about you kind of adjust the degree of each due diligence. So I don't change dramatically. And this is why it's not about bear market, bull market, but it's where our Web3 is at. So my thesis is, I think we have worked on a lot on infrastructure on last few years, and layer 1 and a few others. But now I would say I want to put more effort on application. That doesn't mean that I don't do infrastructure, but let's say I did infra 16, 40 or 70 infra, 30% application back in 2 years ago, because there's no infra. How can you build application? But now I see that infrastructure or layer 1 have a meaningful community members. So now I increase the portion of application and then shrink a little bit on infra.
Is there a thing you just won't touch now? Like, is there something that you won't touch in this market that you would other times?
I think data analytic or those more sub kind of infrastructure is something that I'm personally not that excited about in the bear market.
I guess it's not really like bull market or bear market. Just if we say it's like different year, I guess. You know, in 2019, when we see institutions are really coming into the market, at Tool B, we see institution trading volume percentage increase from 7% to 75% in only like 18 months. And that's where we see like mass adoption of institutions actually coming into the market. So during that time, we were investing heavily into infrastructures or any deal that's related to help with this process, so that they can actually, during that time, get real tractions from institutions. And now, to Steve's point, infrastructures are more ready. We see a real working large number of TPS. So we are focusing on application layer, applications with real mass adoption for users, because that's our thesis for where the real bull market is going to come back next time. That's where we see all the good retail users from Web 2 actually get bridged into Web3. So anything that can help with this process, applications or tools or like infrastructure, so that's where we're focusing on. And I guess during bear market, we like also deals that can generate positive cash flow. So that's something that we're looking at as well. So one example would be, especially given Hong Kong now is like supporting NFT as a commodity, we're looking at Asia-based NFT marketplace, because I think that's going to be a real market. Is going to be getting a lot of the market share from the space. It's just now I think I see problems with OpenSea, even Blur. And I think Asia is going to have a real giant NFT marketplace coming up in the next few years. When it comes to in detailed user operations, it's always Asia lead the way. As for all of the other exchanges, spot exchanges, crypto exchanges, and then large retail platforms. So I think that's one area we're focusing on, and they do generate good cash flow, no matter it's bear or bull.
Yeah, no, I mean, not much to add. I mean, I echo the thoughts that have been shared. I don't think our thesis has changed broadly given the bear market. Maybe the one thing that we do try to think about more is this whole apps versus infra question. And like the reason for that being a little bit, if we are operating in a market where you cannot expect there to be significant retail flows, how much should you be spending? I mean, should you be backing these companies today when they may be sort of dead on arrival if there's no if there's no retail interest at this moment? That's kind of the question that I ask myself. I mean, for what it's worth, I spend a lot of time looking at apps, despite everything that I just said. But I think it's something to think about, right? Like, how much time will they need to actually really reach scale, given the market dynamics, and like, what does that do to the founder mindset, right? Like, when you're just throwing stuff at the wall and nothing sticks because of the macro, not because of your own efforts, perhaps.
But founders still are founding, right? Like, you haven't seen a slowdown in that regards. So I guess perhaps, has it changed at all, or?
No, I mean, I think it's more just it will take longer to achieve PMF if you're consumer facing, is my view today. And that is a different founder journey than maybe building in the bull market.
You know, when I look at consumer applications, the ones that we do invest in, we actually look for ones that aren't looking to get crypto users as their user base. Because I totally agree. Like, what they want are crypto users. It's like, well, now I know you have like X many people that are available to you that know how to use DeFi, right? Versus we're looking for applications that hide the technology and they go after like Web2 users. And that is an infinite market. And then you have to sort of put it in the context of like, is this a good app, period? Not is this a good crypto app?
Right, that great onboarding of Web 2 to Web 3.
Invisible onboarding.
Yes. So the bull market, I guess, was a crazy time for things like valuations or founders' belief that DD is a one-day process. So let's all share a story, not name names, about the most crazy asks from a founder during this last bull market for things like valuations or DD being done quickly. You gotta go in, Dani. Go ahead.
Okay, I'll go. I mean, there were some crazy things happening in the bull market, and we talked about this earlier. Like, you really had to go fast because the good deals also moved very fast. I think one of the craziest ones was a founder, you know, building a cool infrastructure project, put together a beautiful PowerPoint, and you know, went through the presentation of, you know, what is this idea, finished by saying, okay, our valuation is 50 million, and said, okay, do you have a lead? They're like, nah, we're still starting this out. Okay, cool. It's like, okay, so like, where are you right now in terms of your development? Like, have you, you know, where are your devs? Like, have you built an MVP? Or like, no, we haven't started. I'm like, oh, like you haven't started like in production? Like, no, we haven't written a single line of code. I was like,
So,
okay.
no code,
but
$50
$50
million valuation.
Beautiful presentation. The round was oversubscribed.
My lord. Steve?
I think bull market, in bear market, investors become a little arrogant, but I think in bear market, I would say founders become a little arrogant. So they basically give us the 48 hours window to make a decision after first call. So I think that's just crazy.
Yeah, I mean, I think we've all had these horror stories where it's, you know, like it's, you know, the content is all the same now, which is, you know, here's my company, this is the valuation, this is your ticket size, you have 2 hours to decide, and go screw yourself, kind of thing, right? Like, but I guess one small story I can share that was somewhat humorous is, you know, someone was pitching us last year. It was a founder based in Bali, which, I mean, I don't know about you guys, is already sort of not a red flag, but maybe an amber flag. But then we turn on the camera and this guy's in the pool shirtless. No deck, obviously, just talking about his business. And so, like, obviously we didn't end up investing there, but that's the stuff that got done.
Note
in the
to
bear
builders, don't do your first call shirtless.
Yeah, wait for the second call, I would
Okay.
say, at least, you know.
Yeah, get comfortable first.
I see crazier stories in the last bull market, 2017, when ICO was crazy. I've met a founder who had successful launched a project. Token price performance is very good because apparently they were manipulating the price. And then he's like ready to launch a second project. What he had is it's just a picture. It's a picture with a pet. And then he's like, just guess what we're building, but you have to put on your money now. It's gonna get listed soon. You're gonna make money. So just invest now. That's it. I had no idea. Like, what's the vision? I don't know what they're building.
So
I'm not gonna tell you.
pure YOLO play on that regards.
Yeah.
So, go ahead.
A founder told me he raised $1 million on a napkin.
On a napkin.
On a napkin, yeah.
Oh my goodness.
I invested in the later round, but when there was something solid. But I said the first one in the bull was on a napkin.
So I guess though, like it has changed where investors now have the upper hand in these deals, right? Where you have time to do DD over a few weeks, not one day, and your valuations aren't as insane. But how do you stop from like nickel and diming companies? Because you don't want to squeeze everything from them,
Yeah,
But
so
you
I
can't.
think you have to remember that investing is a competitive sport. So like I'm actually not competing against a founder. I'm like competing against the VCs that might want to take my deal, you know, or I invite the friends that also invite me into deals, right? And so if you are a founder and you want to get the best possible deal, you should talk to a lot of VCs. Like I recommend that like founders, like one founder told me they were raising and they had a term sheet and it wasn't that good. They were really squeezing them, and I'm like, how many VCs did you talk to? They're like, oh, we talked to 12 VCs. I'm like, seriously? Like, that's insane. Of course they're squeezing you in that deal. Like, it's your only term sheet, right? It's like you should talk to 100 to 200 VCs to get, you know, 1 to 4 term sheets on average, and then you'll see where the average is. You'll see like where people move the terms. You'll get a fair deal because VCs will compete against each other. Again, not to name names, but like a very, very, very large fund is known to sometimes accidentally compete against itself. You know, so you never know. Put some things on the table, and like then you start to see movement. But if you know, if it's a one-to-one negotiation, then, you know, the parties are going to be polarized. But if you bring more people to the table, you'll end up with something fair based on a competitive market.
Steve, what do you think?
No, actually, nothing to add. I think she covered well. I think exactly how I view it.
No, maybe the only thing to add, I think that helps with this particular topic is actually what Steve mentioned. I think it's also about like, what is your mindset around the time frame of the investment, right? Because maybe if I was the investor who's in it for the short run, then I'll try to be more value extractive and cute when it comes to the deal terms. But if I am approaching this from a, I guess, more classical VC mindset, like this is a long-term partnership for 5, 7, 10 years, well, then it's actually not in your best interest to nickel and dime these folks, because that might have negative implications down the road, or to how they perceive you, or all these other things. It's like, I mean, I think long-term investing is more like a marriage kind of this thing. You do diligence, you date to like understand if you're the right fit, but it's not like you're trying to like win anything. It's a partnership for the long run kind of thing.
Good analogy. And shotgun weddings are, you know, hit or miss.
I think a lot of the recent negotiation with projects are because we're all doing safe with warrant, is now about the ratio. And I don't think anybody is trying to squeeze anybody if like we really like click and really like the team. It's more about helping them understand their strategy for like how to capture the value of the company, like what's the percentage, or what business model is captured by your equity and what is captured by your token. So it's more about trying to help them understand and trying to help them figure out those strategies, and then figure out the right benchmark for valuation. Yeah.
So we're almost out of time, so let's do a quick plug. Tell us your favorite portco under your company and why it's A, US war and crypto proof, and B, bear market proof as well. Go ahead.
Okay. My favorite portco is called Niche. Niche.clubs. And basically, it started by the co-founder of Bumble and Tinder and a senior engineer at Facebook. And the idea is sort of that historically, these applications like Tinder and Bumble that were meant to connect us sort of become something that commoditizes people. And that if Web 2 was about like influencers and like me-centric, Web 3 is going to be about communities. And so what Niche does is it connects people by communities they belong to. So you start a niche community that the community itself owns, right? And then people are invited based on whatever criteria the community decides they should apply. So it could be, you know, because you all own a Bored Ape token. Could also be because you're all part of the Master Gardeners Club, or because you're part of the same alumni group, or because you're like, you know, part of like the Full Souls crew on Telegram, right? And so basically the idea there becomes that it's really about forming human connections and connecting based on your interests, and that's how actually people form real relationships. And so, you know, hopefully it'll make people a little less lonely. Maybe you'll meet some cool friends along the way, or talk to your friends that are in all parts of the world. And I think it's transformational because it is the type of, I think, social media application that we see coming in waves in the future. Niche started probably about a year and a half ago, and even now you start to see a couple of like Gen Z apps that are popping up for Niche for particular things. I'm over time, but it's cool.
Steve, quick plug.
Oh.
Yeah. So first of all, I like all my portfolio company. So if
you must have a favorite. Come on.
No, there's no favorite. I'm forced to pick two. So the first one is first of all League of Kingdom, which is one of the two South Korean projects listed on Coinbase as of today. And what I like about them is they have a huge Web2 knowledge from gaming industry, but they do understand Web3. So I was always looking for gamers, if they come from Web2, they need to solid understanding Web3. So now they are launching the second game. That's what I'm excited. Second one is YGG. I know the founders since 2017. Not many people know, but YGG is the founder's third company. So first two company didn't go well, but I know how he was resilient over failures and then how he applied to third company. And now he's making a global franchise of this DAO, the gaming model, so which I'm very proud of. So I'm very looking forward to their future.
Okay, so first one, Ubox is an Asia-based, Hong Kong-based NFT marketplace. Reasons I already said about it, and they do have a very, very good ability to generate cash flow. Even last year, they made 180 million in profit. And then the second one is actually my all-time favorite is WOO, WOO. WOO invested them very early when they were only 2 founders. Now it's a 300 people team. Very good culture, high integrity, running exchanges, centralized exchanges, and then also trying to change it into a decentralized exchange with order book experiences that can really onboard institutions. So I think that's going to be the future of crypto.
Yeah, very quickly. I mean, similar to Steve, I don't pick favorites, but I can share maybe our most recent investment that we've done in Asia. So it's a digital collectibles company called Anime Metaverse, and as the name would suggest, what they do is they partner with marquee anime IP in Japan, and they help them launch digital collectibles or NFTs for their users. And the reason I mean, it's US proof because it's not in the US, but also I think it's interesting because it doesn't require such a dramatic change in consumer behavior. Anime already has, it's a $30 billion market of which 40-50% comes from physical collectibles. So it's not a stretch to assume that these Gen Z people, as they spend more time online, will also want to purchase the digital version of those. So pretty straightforward.
Awesome. Well, thanks, guys. That was a great panel and a great conference, too. Let's go party now.